After the Tax Cuts and Jobs Act, Section 1031 got a lot narrower. On the EA exam, the first filter is simple. Only real property can qualify. No more swapping equipment, vehicles, artwork, or other personal property under 1031. If it's not real property, stop. There's no like-kind exchange, and any gain or loss is recognized under the normal rules. So what counts as real property for 1031? Think land and permanent improvements, like buildings, foundations, and parking lots. It can also include unsevered natural products, like mineral deposits or standing timber, plus air rights and water rights tied to land. This can qualify, like some leaseholds, especially if state law treats them as real property. Next filter, how the property is held. Both the relinquished property and the replacement property must be held for business or investment. Personal use property, like your main home, doesn't qualify. And here's the exam trap. Property held primarily for sale is dealer property. Inventory. Developers and house flippers usually fail this test because they're selling to customers, not investing. Also, an exchange has to be an exchange. If you sell for cash, that's a sale, even if you plan to buy something else later. That's why most real-world 1031s are deferred exchanges. The usual structure is, you transfer the old property, and a qualified intermediary called a QI holds the proceeds so you don't have actual or constructive receipt of the cash. Now the deadlines. These are hard, calendar day deadlines. First, you must identify the replacement property in writing within 45 days after you transfer the old property. Then you must receive the replacement property by the earlier of 180 days after transfer, or the due date of the return for that year, including extensions. On the EA exam, they love the phrase, earlier of 180 days or return due date. And yes, the IRS is ruthless here. Weekends and holidays don't pause the clock. Missed day, 45, and the whole thing collapses into a taxable sale. Missed day, 180, same result. The only common relief is when the IRS grants disaster extensions. Practical exam tip. If you see a deferred exchange fact pattern, immediately anchor the timeline to the transfer date of the relinquished property. Finally, remember what 1031 really does. It defers gain. If you receive cash or other non-like-kind property, that's boot, and boot triggers recognition up to the amount of boot received. But if you pay boot, meaning you add cash to trade up, paying boot doesn't create taxable gain. It usually just increases your basis in the replacement property. Derek owns a strip mall that he rents to business tenants. His sister, Sophia, owns a residential rental property. Derek exchanges his strip mall plus $15,000 for Sophia's property. The strip mall is worth $200,000 with a basis of $65,000. Sophia's rental is worth $215,000 with a basis of $70,000. What is Derek's basis in the property he received? Think about it. The answer is $80,000. When you give like-kind real property plus cash, and you receive only like-kind real property, your replacement basis starts with your old basis and adds the cash you paid. So, $65,000 plus $15,000 equals $80,000. A tempting wrong choice is $70,000 because Sophia's basis feels relevant, but your basis doesn't come from the other party's basis. Derek and Marisol own competing farm businesses. In 2023, they agreed to swap Derek's inventory of flowers for Marisol's inventory of vegetables. The fair market values are about the same. How should this transaction be treated? A like-kind exchange, an involuntary conversion, a gift, or not a like-kind exchange and taxable? Think about it. The answer is, it's not a like-kind exchange and it's taxable. Inventory is property held primarily for sale to customers, and dealer or inventory property does not qualify for Section 1031. The tempting wrong answer is the like-kind exchange choice, because it feels like a swap of similar business items. But 1031 is real property only after TCJA, and inventory fails the holding purpose rule anyway.